right, let's go ahead and get started. Good morning, everyone. It's Thursday, June 6th. We are going to be talking to you today a little bit about refinancing any kind of property, whether it's a residential property or commercial property. We've decided to take a little bit of a break from the PPP seminars just because we're in the middle of a bunch of change. There's a bunch of flux right now. The House bill that we discussed on Tuesday, the 2nd, was passed by the Senate, and we're waiting for the president to sign that. So we'll be coming to you on Tuesday with some information with respect to that new PPP Flexibility Act that has passed. So today I wanted, as always, to allow an opportunity to have you supply questions in the Q&A box. What I wanted to talk about was we've gotten a lot of emails over the last, 4 weeks or so with respect to refinancing property. Rates are low, the environment is good, and a lot of people have had questions about whether now is a good time, should I wait, the uncertainty of what's going on with COVID. There's a lot of purchasing going on. Mortgage applications are at an all-time high. We're seeing record applications, which is a good indicator for economic recovery, that things are continuing to move in that direction. So the questions I'm getting are all over the place, and I thought since we're getting such a volume, we should address it in this forum so that everybody has an opportunity to also ask additional questions and hear the benefit of this all at the same time. So one thing I'm hearing is a lot of when does it make sense to refinance? Like, is there a drop in interest rate? There is some cost, particularly in Florida, that with the cost of closing costs and documentary stamp taxes, where people will say, I'm not really sure when it's worth it. And the general rule of thumb is at around 0.5% savings. And we don't typically see such volatility in the real estate lending market rates like we have seen over the last 6 months. I have done refinances in the last month for clients of mine who purchased a year ago and already are refinancing because there's been a 1% drop in the interest rate. That rate drop is not only an opportunity for you to enjoy a savings, which during this time, while some people's income is less certain, it also gives people an opportunity to take advantage of some planning opportunities and say, maybe we need to consider not just the decrease in the interest rate, which is of course going to lower the monthly payment, but maybe we need to have a look at changing the term. So you might refinance from a 30-year loan to a 15 or 20-year loan where the payment's staying nearly the same, but you're cutting off such a substantial amount of time to pay. So those types of things are what we want to be looking at, is the overall beneficial result of the refinance. Now, the lenders as well are required to run a benefit worksheet, a tangible benefit worksheet it's called, where they show the difference between the old loan that you had and the current loan that you have. Refinancing doesn't just mean taking out an old loan. You may have paid cash for the property, and now you're saying, you know what, I can get an interest rate in the high 2s or low 3% neighborhood, and maybe that makes sense to take out the equity out of the house or rental property or commercial property and do something else with that money. You may be able to invest it into some other financial vehicle. Maybe your investment advisor is saying, you can earn 4 or 5% in an investment possibly, and if you're only paying 3% on the money at the mortgage company, it's worth it. So keep in mind that we're seeing now an increase in borrowing, even for high net worth folks who otherwise don't need the money. They're able to purchase the property cash. That was one of the big changes that we saw as COVID started to affect our real estate closings. We really didn't have loss of closings per se as a part of the impact of COVID. But what we saw on a much broader scale was people putting the brakes, extending closing, and saying, you know what, I'm going to go from a cash purchase to taking a loan because the interest rate is so low that it doesn't make sense to liquidate an asset, cash out an IRA or a 401k or a brokerage account, and then have capital gains tax on top of that. So those are some considerations. We have to look at the whole picture. And that's one thing that people kind of get lost in the shuffle, because you might start out on a website and, Rocket Matter, Rocket Mortgage, and, there's a lot of online mortgage lenders that have good advertising. And then you start clicking around and it's like, wow, I can get this rate, apply here. It seems super easy. And sometimes it is. But you really need to make this decision outside of just a silo of what the rate is, but really look at your entire picture. And I think that a lot of times people don't know who to call. Should I call the financial advisor? Should I call my CPA? Should I call a lawyer? Everyone's afraid to call a lawyer because they're afraid there's going to be a giant bill. But that's not the case. It doesn't need to be that way. But you need to make sure that the refinance is accomplishing as many objectives of yours as it possibly can. So lowering the interest rate or shortening the amortization period of the loan are both fantastic outcomes. I don't want to minimize what benefit that is. But on the other hand, I also want to say there are other considerations to make, like ability to deploy capital in a different way. If you have rental properties and you've historically paid cash for them, taking a loan out against those properties may give you an opportunity to buy more property if that fits in your investment model. So those are, just a handful of things that I would say we want to start to explore. So the interest rate is great. That's the first place to start. But if you can have a conversation, again, we're big on teams here, with a team that includes your CPA, your financial advisor, your lender, your lawyer, or any combination of those folks, you're going to get better information. So that's what brought us to the table today and why we wanted to reach out. So let's talk about the tax impact. Mortgage interest rates have always been deductible on your tax return. They will continue to be deductible. After the Tax Cuts and Jobs Act, mortgage rates over $750,000, mortgage interest attributable to loan balances in excess of $750,000 are not deductible. However, if you had in place an existing loan of $1 million and you've refinanced that, and it was from before the Tax Cuts and Jobs Act was effective, you're going to get one-time refinance where you preserve that $1 million loan balance as what's deductible. So that's another strategy that you want to keep in mind when you consider refinancing, particularly at a loan balance like that. 0.5% interest rate makes a huge deal in the payments just because of the loan balance. So there's tax deductibility of that mortgage interest that you're not getting if you paid cash. I never want people just to borrow for a tax deduction, because even if you get a 25% tax deduction, you still spent $1. So 25 cents write-off for $1 spent. We want to be intentional about doing that. You don't want that don't just spend money to get a tax deduction. However, if you had paid cash for the property or you have a mortgage, but now the property is appreciated and you can pull more equity out of that property, that's something to consider. What else can I do with this money? Should I invest with my financial advisor? Should I buy another property? Should I have cash for a rainy day? If you're in a business that's maybe not suffered financial impact yet, but you expect it to come down the road as a delayed result of COVID, there were lots of businesses who, just the nature of the way the income comes in, they may have already not felt the loss yet because their closings of the new transacted business are maybe 6, 8, 10, 12 months out. So if they stopped writing new business in April, it's going to be, next February before they feel a financial impact. For folks like that, it's a good time to consider possibly taking some equity out of that property now, so that you have it for when you need it if you're expecting any kind of lull. I think a lot of times people are afraid to talk to a lender until they're ready to go. There are lots of local lenders that we work with who will do a great job educating. The people that are in this business, that are the professionals, are there to educate you, not just sell you a loan. They have an obligation to ensure that your refinance gives you a tangible benefit. But more importantly, from a strategic standpoint, does it make sense to do now? Should you wait? Rates have fluctuated up and down. But overall, now is a really great environment, and we want to make sure that we maximize the benefit to you. There certainly are some costs associated with the refinance. in Florida, you're going to pay documentary stamp tax, you're going to pay intangible tax, recording fees, title insurance fees. The lender's going to have fees. So those things we want to look at not lightly. Typically, I would say, if you are refinancing the property, you need to not only experience at least a 0.5% decrease in the interest rate, but you need to intend to keep that property for about a year at a minimum. If you intend to keep the property long term, then this becomes even bigger no-brainer. But sometimes people will say, well, I was getting ready to sell. If you were getting ready to sell, but you're not sure, you still might take it into consideration. Those fees that you pay with that refinance, you don't get back, and there's no way to pass that benefit on to your buyer. So that will be sunk cost money. So I want to make sure that we're not just doing a refi for the purpose of churning a refinance. You don't want that. But if you've got a good team and you can chat with your lender, they can talk to you about timing this refinance strategically. The lenders that we have worked with have all been very, very upfront about where they see. Of course, they don't have a crystal ball, but with this is so particular to you. You can't say, well, my sister did, or my cousin did, or my friend down the street refinanced and this is what they got. It's very unique, just like tax returns. People say, well, how much refund did you get? It's so individualized, it's difficult to compare. However, those mortgage professionals do have their fingers on the pulse of where things are going with respect to your particular circumstance, and say, now is a good time, wait a couple months. If you have credit issues as a result of missed payments from this, you may want to, they may be able to even help with some credit repair to say, okay, do this for 6 months and then come back. When you are operating from that place of information and that place of education, it's so much easier to make a very well-informed decision. And then you're not just going off of some online advertisement of a low interest rate. The interest rate isn't the only thing you should be shopping on. Many lenders have additional fees, and that needs to be compared as well. So one thing that you'll hear about is an origination fee or a discount point. Sometimes if you are, especially when you're online and you're not able to talk to a person, the interest rate may be lower, but you're paying such a high discount point that the cost to take the loan or acquire the loan is offsetting that interest rate. That's what's making the interest rate lower. And so when we see that becomes another thing. It's not that one is good or bad, it's that it needs to be evaluated with your goals. If you're planning on keeping that loan for 20 years, then you may want to pay a higher acquisition cost for the loan and have a lower interest rate. But on the other hand, you may say, well, we're probably going to move in 3 years. Well, then you may not outrun that expense. So the costs are something that need to be looked at before you go into this. And it can be difficult to do a side-by-side comparison because, like I said, if the interest rate is the only thing you're looking at, you may lose on the scale while you're weighing what the other expenses are. Some banks charge processing fees, document review fees, document preparation fees. So we need to really have a comprehensive look at what all the fees are before you decide which program you're going with. Even inside each lender, they offer different programs. Not only is there FHA, VA, conventional, condominium loans look different. The way the pricing is of those loans can be different. So we really need to spend, some time shopping to make sure that you've got the right product. So your time frame that you intend to keep the property or keep the loan, the interest rate, the cost of the refinance are all the big factors, and most of those people are aware of. When we talk about what else you can do with the money, that's where we want to maybe go to a different layer, a different level of consideration for what we're going to do. So you don't want to take the money out of your homestead property without consideration and go into a risky investment. That homestead equity is protected under the Florida Constitution. So we don't want to, be flippant with what we do with the proceeds. But it certainly is an opportunity to allow you to free up some capital at a very attractive rate at this point in time. So when it comes to the process, that's another ball of wax. People, if you haven't taken a mortgage in quite some time, sometimes we're working with folks at closing and they say, I haven't I haven't done a loan in 10 years or 25 years. The process is different. Several years ago, the TRID Act was passed, and as a part of TRID was enabled as a part of the Dodd-Frank Act, which was passed. And I always joke at the closing table and say, neither Mr. Dodd nor Mr. Frank have ever done a closing, because the rules that we got as a result of that act were incredibly cumbersome. And now what happens is sometimes you get the closing disclosure. You are required to get a closing disclosure ahead of closing that you acknowledge 3 days before you can close. And that closing disclosure, particularly at the beginning of the process, isn't always accurate. So people will become concerned and say, oh, it said the closing fee was higher or the survey fee was higher, and now I don't know how much money I got to bring to closing or how much money I'm going to get back at closing. You have to take that closing disclosure, I hate to say this, a little bit with a grain of salt, because they're not always final figures when you are initially given that. That closing disclosure is designed to replace the truth in lending and good faith estimates that you used to get as a part of your mortgage process. There are certain tolerances inside those estimates that the bank must adhere to, and if they are inaccurate, then the banks are required to pay the difference. So the banks are very generous with the estimates to ensure that they have not under-disclosed or underestimated the cost. Even in a purchase, we see this, but I want to talk mostly today about refinances. But in a purchase, you may, the lender, if you were getting pre-qualified before you found a property, they're required to give an estimate for the survey. They don't know if you're buying a 3-acre property or a lot block legal description in Lakewood Ranch. So that survey fee is going to be different, and they're charged with the duty of disclosing fees for something they can't possibly know before you've selected a property. So some of that, I don't want to say take loosely, like it's not like there's something untoward going on. It's just difficult to make some of those estimates at the time that the lender is required to do so, because the rules were made by people who aren't involved in the process. When it comes to the process and what the application process looks like, it is cumbersome, but a lot of lenders have moved to an online platform where you do have an opportunity to do some typing, and if you aren't sure where to put something, especially if you're working with somebody local, you'll have an opportunity to say, hey, I've got kind of a weird situation and I need to explain it. We also want to be open-minded to businesses that may have some challenges right now as a result of COVID. The lenders are not just saying no. And I think that people initially thought you're not going to be able to get a mortgage because of the uncertainty with COVID. And I will say every single friend and colleague of mine that works in mortgage, every time I see them, looks exhausted. They're very busy. They are taking lots of refinance requests. And so I want to make sure that people understand the types of issues that you need to be exploring. I'm not able to give you a takeaway that says, aha, look for this and this and this, and that's a good mortgage versus a bad mortgage. It's just not, you can't put a general rule about it like that, because it is so specific to each person's, not only financial situation, credit situation, the type of the property, whether if you're in a condominium, it's down to how much percentage of the owners are occupying the property versus what's rented, and that changes the loan program. So it's far and above more than what you could possibly anticipate the variables to be. So all you can do is really have your own fact pattern in mind and be very clear about what your concerns are, so that when you speak to the mortgage professionals or to the lawyer or to the accountant, you can gather as much information as possible. We frequently help clients determine which program they should explore. The lenders do a really great job of walking you through the pros and cons. This is a conventional loan, this is a variable loan, and walking through your intentions, what you plan to do with the property. During 2008 and 2009, when we had the mortgage meltdown, a lot of things that are customary to the mortgage industry got a really bad name. For example, loan servicing. Often at the closing table, people express concern to me and say, oh, are they going to sell my loan? Loans have always been sold. It's not a problem. There's nothing shady about it. It doesn't change your interest rate, your loan amount, or your monthly payment. It changes who you write the check to. Teacher retirement funds used to buy those mortgages in batches. There was nothing, unprofessional about that process. It just got a lot of press during the meltdown because of the lost documents and things weren't done properly, but nothing about that caused the problems with the values and the appraisals being crazy and things like that. So same thing when it comes to types of mortgages. I'll hear people say reverse mortgages are bad or variable rate mortgages are bad. There's no such thing as a bad mortgage. Negative amortization mortgages probably weren't the best plan, but you don't see those now at all. I haven't seen one in more than 10 years. But what we see is those variable rate mortgages are perfect if somebody is in a transitional house. Maybe you're buying a starter home, maybe you're buying a home while you accumulate wealth for a larger home or a home on the water or something like that. If you're looking at that and you're not going to intend to keep that mortgage for longer than 5 or 7 years, then, or some people are nearing the end of a life event where they expect some liquidation. Maybe you're getting divorced, maybe you're selling your business. You say, I'm going to take a mortgage for now, but when X happens, when I sell the business, when I sell my property up north, when I get divorced and get my settlement, then I'm just going to pay it off. You may as well enjoy, there's typically a lower interest rate associated with a variable rate loan, although in this environment, they're pretty close. But those are, other practical considerations to make. And that's why I'm suggesting don't just jump online and look at an interest rate and hit go. There really needs to be some, at a minimum, internal discussion if you're not having discussion with an outside professional. Those mortgage interest, I think there was a period of time where people felt like, ooh, a mortgage is bad and paying cash is good. The script started to flip a little bit when people became concerned with asset protection. This is another area where I hear a lot of things that are inaccurate, and people will say, well, I need a mortgage so that Morgan & Morgan, for the other people, don't come after me. If there is liability, they can still get a judgment, and that judgment attaches to you personally. So having a mortgage in and of itself, yes, it is in priority over any kind of judgment like that, so that you would pay the bank first. But that's, again, tail wagging the dog. That's not the best reason to do this, although it doesn't mean that you shouldn't have the mortgage. So that seems to lend itself to some confusion or some misinformation when I hear that come back to me from folks. We want to make sure that you're not a serial refinancer, because that can turn costly. But and there are certain types of mortgages like the reverse mortgages where with the costs you don't want to be doing them more than once or frequently. But like I said, I've closed people recently who just bought last year. There is no time frame where you'd say, oh, you have to wait X number of days to refinance or X number of years. There really isn't. You really just want to keep an eye on where your existing rate is. If you don't know that, you can pull out your current loan documents, and your promissory note will say it. Most loan statements will list the interest rate. Oftentimes they'll list the maturation date too. So you'll see how much time is left. If you have a variable rate, you'll see when that rate will adjust. Adjusting of the variable interest rate is another misconception, where people say, oh, my rate's going to adjust in 2 years, I have to refinance. Well, your rate will adjust and it can possibly go down. People don't understand that necessarily either. So there are some benefits to variable rate mortgages, even though sometimes they're associated negatively because people have had a bad experience, but the product itself isn't something to be scared of. Also keep in mind that there are other amortization periods. Like I said in the beginning, you may be able to go at the same payment, if you're comfortable with your payment, and drop to a 15 or 20-year mortgage rather than 30. So you could either stay with 30 and lower your payment, or lower the amortization period and be mortgage-free faster. Another thing that I see people ask me about at the closing table is whether they should pay bi-weekly. Most lenders are not big fans of 2 payments per month. Some will charge you more if you do that. Some just will not accept the payments. What you can do is make a payment, an additional payment of principal with your regular monthly mortgage payment. The standard rule of thumb is that if you make 1 additional payment per year, you take about 7 years off of the mortgage. And that can be done whether you're adding additional money monthly to your mortgage payment and paying principal a little bit monthly each month over the year, or if you make 13 monthly payments. That really all shakes out. There's a tiny benefit to doing it biweekly if the lender will permit it, but most of them don't. And even if they do, the administration of that gets a little cumbersome. So the accounting and ensuring that it was handled properly sometimes is more inconvenient for you as the borrower. So those are just some other things to, to kind of keep in mind. The process to apply is also in some ways more cumbersome and in some ways a little bit more streamlined. As I mentioned, a lot of the mortgage application process can now be done digitally, but they do ask for quite a bit of detail. A lot of times people complain that they're submitting the same information more than once. You sign a lot of what you signed in the application process when you're at the closing table with me. You sign the application again. You sign 4506T, request for transcript of tax returns, again. And that's just, none of it is a problem. It's just, sometimes people roll their eyes like this process. It's definitely, it's not as bad as calling Verizon customer service, but it's not the most enjoyable process. But if you are organized and if you have, if you are good with your paperwork, you will experience a lot less frustration. Who does have a little bit more frustration are folks particularly with multiple businesses, especially if those businesses are not terribly active. So maybe you got an extra LLC that really doesn't do much. People are always annoyed that the bank wants to see bank statements and profit and loss statements and tax returns, and you're like, that's not really a real business, that's just my side thing. And it's funny to see how this unfolds as people start to explore it. So another issue that I see come up is when it comes to, especially with rental properties, LLCs or trusts. And the trust may be with your personal property, not just a rental property. Many lenders are not willing to loan to an LLC. And I've had this come up in both the residential and commercial context. Lenders sometimes will say to people, yeah, don't worry about it. We have to loan to you in your individual name. You're going to take that mortgage as Joey and Koontz individually, and then you'll just transfer the title by quitclaim deed after closing. First of all, there is technically a due on sale clause in your mortgage that says you will not transfer title unless you pay off the loan or get written permission from the lender to do so. The lenders will not give you the permission because some of them will not underwrite loans to LLCs or to business entities. Not really sure why. They would get a personal guarantee. The lending situation, your obligation to pay is the same, but it's pretty consistent through lending institutions that many of them give people trouble when it comes to LLCs. We do have a battery of lenders that will loan to people with an LLC, but if you are stuck with one particular lender, you may get the answer of no. And so oftentimes lenders will unfortunately convey that as though it's very easy, just do a quitclaim deed and you're done. The process of doing the quitclaim deed after the closing or after the refinance is easy. The problem is in Florida, you're going to pay the documentary stamp tax again, and there's no way around that. So it gets expensive very quickly to just do it twice. Then if you're in that situation, you want to, you can give us a call or give a lawyer a call and make sure that someone has helped shepherding you through the process with the lender to help make sure that they understand what you're trying to do and why. And if that lender isn't able to process that loan that way, you may need to find another provider. I'm certainly not a big fan of upending relationships. If you've been with the same lender, particularly a local loan officer for some time, you want to stay with them, but you also need to buy a product that works for you. And simply making those kinds of transfers afterwards is incredibly expensive and oftentimes unnecessary. We see the same thing with trusts, but there is an exemption for the transfer of title from an individual into a trust, at least with respect to the doc stamps. You still technically have the due on sale clause issue, but you at least have not a double dinger on the doc stamps. When it comes to rental properties, we do want to see those in an LLC. You don't want to have a rental property in your own name. Again, that's beyond the scope of what I want to do today. I want to stick to the refinances, but it's all kind of intermingled. And this is another reason why I continue to say, can't be in a silo. You know, you're not going to get that kind of advice from a CPA or from a loan officer. It needs to be a teamwork approach. If you decide to endeavor upon the process, like I said, paperwork needs to be in order, documentation will need to be provided, and you need to be available. Another COVID impact that we've seen on mortgage closings is that people don't necessarily want to physically appear at closing. There are, from my understanding, about 12 lenders at this point that are participating in what are called RON closings. RON stands for Remote Online Notarization. That is the way in which you can complete a notarization of loan documents without seeing digitally. You go through a platform that specifically RON certified notary is able to use. You're not allowed to use Zoom or FaceTime. Those are not secure enough for a transaction like this. So the state of Florida has put a prohibition down for that when they wrote the RON registration rules. Now, not every lender is participating because RON, the remote online notarization, means that you're signing the documents digitally. Just like when you sign through DocuSign or a digital program, it's a digital signature. The notary's acknowledgement is digital, and many lenders are not comfortable with the impact of that and how that will come down in court cases later if you don't pay. So we've seen the great majority of lenders not permit a RON closing for the loan. You know, for some of the documents they'll allow it, but not for the mortgage, and they typically want a wet signature for the note. But if you are comfortable appearing in person, you are able to either have a mobile notary come to you or come to the closing agent's office. Another issue that we're seeing heightened now, but is always pervasive, is when spouses are not together. That creates an issue if you're trying to complete your mortgage refinance or mortgage closing, even for a purchase, and the spouses are in different states. It's best if you're together. It's best if you're present with the closing agent to avoid any concerns or inaccuracies. Notary rules are different state to state. So frequently when we receive a loan package back from a notary who's notarized out of the state, we frequently find deficiencies which can delay the funding. If you're using the refinance funding, speaking of that, to purchase another property, that mortgage refinance, if you are refinancing a primary residence in the state of Florida, takes 3 days to fund. You have a 3-day right of rescission. So you need to be mindful of that so that you have your funds in time for the second closing if you're going to be buying something else with those funds. A lot of times people aren't aware of that and they don't realize they're not getting the money the day of the refinance closing because we've got to wait 3 days for that to fund. So those are kind of the concerns that I have on the front end. Like I said, I'm happy to field questions if anyone has questions. We want to make sure that that process is as smooth as possible, and also not only in the application process, but in the execution. Frequently people set themselves up simultaneous closings. They want to sell and buy in the same day, and it's certainly permitted, but these are all things that add to the stress and aggravation. If we can put some time between those, it's better. If you know that there's a 3-day right of rescission on your primary residence refinance, that makes it better. Keep in mind also, homestead property. Doesn't matter who the title is held by. If it's me and later I get married and my husband is not on the title, when I go to refinance a primary residence mortgage, my husband is going to have to sign because under the Florida Constitution, you have a constitutional homestead right to that property, even if your name isn't on the deed, if it's the primary residence and you're married. So we see this come up where there is some estrangement or military service or something like that, where the spouses are not together or possibly even acrimony and they're not communicating. Divorced is divorced, and until you are officially divorced, you are still married. So sometimes we'll see people buying the next home or refinancing the home as part of the divorce, and the soon-to-be former spouse is still required to sign the mortgage. Even if they're not signing the note, that is something else that people don't necessarily always appreciate the difference for. The promissory note is your obligation to repay the loan. It's the contract for the financial arrangement. The mortgage is the lien on the property. So that's how you promise to pay in the promissory note. And if you don't pay as you promise to pay, the mortgage allows the lender to take the property back in the foreclosure because you didn't pay. So it's like the promise to pay versus the ability to take the property. Those two documents are separate and they're different. You'll hear people say in conversation, I owe $300,000 on my mortgage. You don't owe any money on the mortgage. You owe the money on the note. The mortgage is simply the tool for the lender to take the property back. So if it's a homestead property and if there's a spouse, even if they're not listed on the title, they still have a homestead interest in the property. They're still required to sign the mortgage. That means they need to be aware, they need to be cooperative, they need to be available. So this, if you are looking at the refinance as a part of a family transition, that's another layer of consideration that you need to make, that this person does need to be available. Sometimes we see people who are refinancing to get the cash out to pay a settlement in a divorce, or we see them just trying to get one person, you know, the person who's leaving is coming off the property and they want to come off the loan. The only way you can't get rid of somebody who's on a loan, you've got to do a refinance in order to have that spouse not be a borrower anymore. And sometimes we'll see people try to take matters into their own hands and they say, oh, there's a divorce situation. I'll do a quit claim deed and take him off the property. You might take him off the deed, but you're not doing anything with respect. If he was a borrower when you borrowed the mortgage, he's still going to be a borrower even if you take him off of the title. We see that come up in divorce a lot, and even sometimes the divorce lawyers will say, oh, you guys go do a quit claim deed. Well, that doesn't, now I don't own the property and I'm still a borrower, so I don't have any control over how this happens. So that's something else that's, it's, you know, a deeper niche than I want to dive too far into today. But if the reason for the refinance that you're considering is divorce, that also needs to be done, again, on a team: real estate lawyer, accountant, divorce lawyer, lender, and really make a plan about how you're going to proceed with that. Sometimes the refinances are for, I hate to say a good reason versus an unhappy reason, but you know, there's lots of motivations on why people are doing this, far and beyond interest rates. So always something to keep in mind, always something to look at, make sure you're looking at your individual circumstances, why you're doing it, what the benefits are. And if you say it out loud, there may be benefits you hadn't thought of. If you are interested in the refinance and you don't know who you should be speaking to in terms of a lender, you can email me. We certainly will provide you some names. We really do like to work with local people. Those local loan officers in our community are in understanding of market situations. You may find an online lender isn't able to write a loan in a condominium or in an unusual circumstance because, you know, maybe there's a construction issue and they don't know what to do with it. Our local lenders have already been familiar with those particular nuances of different communities, and it makes it a little bit easier to get the underwriting through, or if there needs to be an exception, or if there's a dispute to the value that comes in on the appraisal. So I think that's it for me. If we don't have any questions, I just wanted to bring that information to you guys. If you have anything with respect to real estate questions, whether it's purchasing or financing or selling commercial or residential property, we can help. We will be back. We will talk to you on Tuesday. We're going to bring to you, hoping that the president signs the PPP Flexibility Act into law, and we'll have an opportunity to review the specifics of how that will affect you. If you have any questions, please let me know. Thanks so much, guys. Have a great weekend.